Thank you. It is entitled Safe Havens in Testing Times, Opportunities to Future-Proof Investment Portfolios. And just as soon as the furniture is arranged, I'm going to be calling up our esteemed panel. I can see you're all sitting there and ready to go. Your enthusiasm is enough to boil water from a distance. We're almost there, ladies and gentlemen. Please bear with us. Right. Come on, guys, you were faster in rehearsals. You can do better. Again, give them some encouragement, everybody. Which one? Okay, look, I'm going to start calling people. Make your way serenely to the stage as I call your name out. First of all, on this panel, I would like to ask for Ali Jaffari, Chief Financial Officer at DHF Capital SA, to make his way to the stage. Thank you. Our next panelist is Aisha Abbas, Head of Consumer, Private Banking and Business Banking for UAE Standard Chartered Bank. Hazem Fawad, Head of Investments, Mashreq Private Banking. Saqib Mahmood, Group Chief Commercial Officer, National Bonds Corporation. Faisal Hassan, Chief Investment Officer and Head of Asset Management at Al-Mal Capital. Mr. Haitham Juma, Unit Head, Investment Solutions at the National Bank of Fujairah. And our moderator for this panel is Mr. Walid Salem, IT Lead, Middle East Zurich Insurance Company. Give him a big round of applause too, everybody. Okay, Walid, pick up the pace. You've only got 45 minutes. Yes, let's have it tidy, please. Okay, Walid, over to you. Thank you, everybody.
Thanks a lot, everyone. So, can you hear my voice? Okay. Welcome to the third panel for the day. Can you hear me? Okay. Yeah. Welcome to the third panel for the day and the last one before the network lunch. Safe havens in testing times. Title of have experts coming from different organizations today sharing with us their experience, expertise, and their stories. The uncertainties, the challenges, the geopolitical situations, as well as economical problems, high inflation rate, which means that we need to think about cannot hear. Hi. Okay, I don't know from where I stopped, but anyway, yeah. So, the uncertainties, the challenges, the high inflation rate, geopolitical tensions, as well as environmental issues still linger, which means that we really need to think out of the box and identify the key economic risks that we need to keep an eye on in order to ensure that our customers' investment portfolios are in safe haven. As inflation rate has reached a level that we haven't seen over the past 20 years, putting key challenges and risks. What are the key risks associated with that on our customers' investment portfolios? As the United States Federal Authority has been working over the past 2 years in order to fight the stubborn and escalating inflation rate, what are the opportunities or probably the threats associated with all those things on our customers' investment portfolios? In this challenging world and during these situations, can we consider that the fixed interest bonds is a must-have in our investment portfolio? Additionally, do the traditional investment options we have today, like the stock market, the gold, the silver, probably the fixed income, so probably this bank saving accounts or saving the money under the bed mattress, are these still available options in today's era? What about the movement that has been happening by majority or many of the global central banks in order to legalize and regulate the use of cryptos and the digital currencies in this industry? Do we foresee a future investment promising opportunities in investing on these assets? In addition to that, while we all live in GCC states generally and UAE particularly, what are the views the global investors as well as the local investors have on our GCC economy as a safe haven? We are gonna talk about all those things, and our experts will shed some lights on all those topics today over the coming 40 minutes. Don't ask me how, but this is because I myself don't know how, but this is what we need to do in today's discussion. And something I can assure you is we'll definitely have a good network lunch today. So anyway, let me jump to the discussion. I think Andrew is keeping an eye on me. I'm afraid I will be speaking about the network branch over the coming 40 minutes. So let me jump to the discussion now. So Ali, happy to see you with us today. Thanks for being with us. Ali, the challenges, the uncertainties, as well as the economic problems, the high inflation rate, the high interest rate is still linger, which means that we really need to keep thinking out of the box and identify the key economic risks that we need to keep an eye on in order to ensure that our customers' investment portfolios are in safe hands. What are these key economic risks that we need to keep an eye on, Ali? Going to you. After introducing yourself, please.
Great. Good afternoon, everyone. I'm Ali Jaffari, Chief Financial Officer at DHF Capital. At DHF Capital, we provide leading wealth management solutions. We leverage AI technology to build and structure financial products that offer greater diversification and risk-adjusted returns that are different from traditional products out there in the market. Thanks for the question, Walid. There's a lot to unpack there, so we can get straight into it. You talked about high inflation. We've been hearing from the Fed. We've seen the recent central bank decisions coming out of the US in terms of the rate hiking cycle being on hold. We continue to experience high inflation, and it's clear that the current level of inflation is far away from the Fed's desired target range of 2%, right? What we've seen over the last couple of years is the Fed be reactive to the market sentiment. We've seen a lot of asset classes that have traditionally been safe haven asset classes that are no longer providing the same level of return that we experience, and it's important to discuss how we can position portfolios in light of this turbulent time to be able to address some of these issues, right? If we look at traditional asset classes, and this was mentioned in the last presentation, the 60-40 rule when it comes to equity and fixed income may no longer work in the current environment, right? We're seeing a lot of volatility in asset classes that we haven't seen over the last decade, such as foreign currencies, what we're seeing in commodities, some of the metals, and it's important to think through how we can continue to diversify portfolios while still having a broad enough exposure in light of the current market time, right? When we look at the rise in interest rates, the impact that we've seen on equity markets, the impacts that we've seen on fixed income, it's becoming a continual question as to what comes next from the Fed in terms of its policy. And how do we follow here in the GCC region, right? We need to understand that the return cycle that we've seen over the last several years is not going to be the same landscape that we continue to see in the coming years, especially when it comes to traditional assets like equities and fixed income, right? The investor return profile that was acceptable over the last decade is not going to be the same over the next decade. If we look at the yield curve right now, if we look at treasuries from a 1 to 10 year basis, you can see on the short term that you're generating yields of anywhere from 4.5 to 5.5%, but there's still a significant decline that you see in the yield curve where the 5-year and the 10-year yield is less than that. There's almost a 50 to 70 basis point gap. So the natural questions becomes, how do you think about, addressing that gap? And as an investor, do you look to allocate a significant proportion of your portfolio into some of these fixed income assets where you can generate and lock in a yield of 5%? Is that more analogous to equity-like returns that we've seen in the past? And where do you position yourself in these times, right? And it's a natural question, and it's a challenging environment to think through all the risk considerations that you see, right? Just to address your point on some of the key risks that we've been seeing across the globe, inflation, of course, continues to be a very high risk. And what we've been hearing from the Fed and other nations is this is here to persist, and we're nowhere near our 2% target. An important point I wanted to mention is China. When we look at the China story and the deflation that we've seen over the course of the last year, the China story has actually been supporting part of the disinflation that we've seen globally, where we have come down, right? We haven't come down to the desired level that central banks require, but it has come down. However, one of the key risks that I wanted to acknowledge is as we start to see the Chinese economy pick up and grow and more capital flow out of China into the GCC region, that imported inflation is yet to come, and that's something we need to be conscious of.
Thanks, Ali. A very important takeaway here. According to Ali, UAE and GCC states are considered as a safe haven for investors. So any input from anyone here, any question? Okay, cool. So let me move to Aisha. Aisha, Ali has stated that GCC as well as UAE are considered as a safe haven for majority of according to him. So what are the views that investors locally and globally have on GCC states as well as UAE economy?
Thank you very much, Walid. Good
After
morning.
Introducing yourself, yeah.
Yes, of course. Good morning, good afternoon, everyone. My name is Aisha Abbas, and I'm Managing Director, Head of Consumer Private and Business Banking for Standard Chartered Bank here in the UAE, mainly looking after the affluent segment of the clientele, and which brings me to the point around the UAE and the GCC. But just before I get to the UAE and GCC piece, I just wanted to talk a little bit about what the gentleman here and the one before us was talking about, whether you choose carefully and then remain diversified. So there's always that argument around don't put your eggs in one basket, but at the same time, maybe put all your eggs in one basket, but watch that basket very carefully. So there is a place for your traditional investment products and alternatives in your portfolio at all times, depending on which spectrum of your investment life cycle or your financial planning life cycle you're at. So whether you're a startup investor or you're a seasoned investor looking for returns and looking for yields in a short term, then there's a variety available for all of that. And it's important to note that high interest rate environment is not a bad environment, and similarly a low interest rate environment is also not a worse off environment. There are plays that are available in both those cycles, which many of us have seen. Now coming back to the point of the GCC and specifically the UAE, absolutely, it is a safe haven. I can talk specifically about the UAE with its D33 plan. The leadership of UAE is very keen to double GDP, and they're even considering manufacturing locally. I mean, this is something we've never heard of before in the UAE. Also in terms of the infrastructure, the safety, the provision of education, the provision of visas, the ease of setting up businesses, ease of setting up families. UAE has everything to offer, both obviously to nationals, to residents, and those who are making UAE their home. So even to the extent that if you are working and employed in a company in the UK and you are working from home over there, you can still make UAE your home and work out of here. So there's a lot of foreign direct investment that is coming through. There's a lot of private investment that is coming through. The property market is at an all-time high. And there is a lot of sort of speculation around that as well. But if you notice around you, most of the people who are buying to live, which means that they are making UAE their home. UAE also offers for women, for children, people otherwise a very, very safe place. And these are some of the things that gives UAE that edge of people wanting to set up businesses here and making UAE their home. And also in terms of the financial services industry, it is very starkly evident within the D33 plan as well, that UAE wants to become the next Switzerland, the next Geneva, the next Zurich, where assets are booked here, they're booked onshore. And that is also attracting a lot of financial services industries to come and set up their businesses in the UAE. So absolutely, it's a safe haven. And if we go beyond the UAE as well, if we talk specifically about the GCC, the fact that there is free flow of money within the GCC with the pegged currencies as well, I think that makes the ease of doing business even more practical for both the consumer as well as businesses. So I can go on and on about the GCC and UAE being a safe haven, but I'll ask my other colleagues to also give their 2 cents. Thank you.
Thanks a lot, Aisha. It's a very important view from a global bank like Standard Chartered Bank. Let me hear the same view from Saqib as a local investment.
Assalamu alaikum. I'm Saqib Mahmood. I'm the Group Chief Commercial Officer for National Bonds. I agree with Aisha what she has said that, the GCC, of course, we have seen over the last few years how, the wealth flow has come in. And it's all to do with what she was saying that, the political stability we have here, the connectivity, actually the geographical location, obviously, we've all seen that, we can fly around, to Asia, Europe. It's so conveniently located here, to Africa as well. So I think all these things combined gives a lot of credibility, a lot of, opportunity for people to come in. So, what I've seen in my previous jobs as well, wherever there is a political stability, you start getting that influx of money. So I think this is one thing which comes here very, very strongly. The other thing is safety and security, what she mentioned. I was just talking to somebody earlier outside that probably this is Dubai now or UAE in general, is the only place in the world where I think I just left my phone there and came here. So, the other day we tried similar thing in a cafe in London, and we paid a very heavy price for that. So honestly speaking, everybody, who comes here wants to stay here. And I would like to just share with you some, we at National Bonds, we carry out a detailed survey every year, and we have been doing that for last 12 years now. And this year and the last year, we got some very, very strong results. People are very clear in their head what they want to do. Let me share some numbers, and it was eye-opening for us. And inshallah, when you see that, it gives you a very, very clear indication what people want. So almost 76% of the participants are thinking about saving and investing in UAE. And this, a lot of them are young individuals which are less than 30 years of age. More than 1/3 of respondents are looking forward towards retiring in UAE. So this is something new which we have seen, and especially a lot of Westerners, we saw that, once they complete their job here, they tend to go back. So, but this trend is almost 63% in the Western expats which were here. 52% of the respondents, they said that, they want to increase their savings and investment in financial products in UAE. Both Emiratis and the expats, they want to, start their own business here within 3 to 5 years. Well, most of them, they said that. Purchasing a home here and settling down here, and securing education for themselves and for their children. So with these new universities which we have done, new campuses have opened up all the famous universities here. So I think this is also becoming an education hub as well for a lot of people. And the last point I have here is that 82% of the employees in UAE are open to employers investing their end-of-service benefits here. So when we saw that at National Bonds, we came up with products, and we started offering these to companies around, starting from small and medium companies, to ask them to, invest their end-of-service benefits with us. And we are seeing a huge success there. We called it Golden Pension Plan. And we are seeing companies with employees up to, starting from 3-4 employees up to, I think the biggest company we have has 13,000 employees. And now with the government coming up and, pushing the end-of-service benefit security, I think this is going to be a program which we rolled out all across. So all in all, I strongly believe that, this is a safe haven, and we are going to see this. The UAE and GCC has shown resilience in the last 2-3 years as well. So I'm very positive about it. Thank you.
Thanks a lot, Saqib. Thanks a lot. Coming to Haitham. So, as everybody here is aware, so the inflation has reached a record that hasn't been seen over the past 20 years, which causing a challenge and risk on the customer's investment portfolio. What are the risks associated with that, and how to ensure that our customers' investment portfolios are in a safe haven?
Thank you. I think I'll start off the macro discussion here. To start off about your point about inflation, I think it's best to start and set the stage of what is the reason that has led to this huge, I would say, spike in inflation, despite the central banks over the past decade trying very hard to actually stimulate inflation and increase it. I would say this came in mainly because of what has happened during the pandemic. Over the last decade, yes, central banks were printing, monetary policy was very loose, but we haven't seen this level of inflation. However, in COVID, what happened is that money was actually handed out to people. Saving rates increased. So the amount of money that's saved in the consumers was much higher. On the other side, the supply side was very weakened. A lot of the factories had to shut down or even reduce the production level because of that pandemic. So all of a sudden you have this huge demand-supply imbalance, which has led to the sudden spike in inflation. In the past, the ultra-loose monetary policy, yes, it helped consumers buy more, but at the same time, it also helped suppliers build more and produce more. But during the pandemic, during the years of 2020 and 2021, that was not the case. And this is the reason where we saw the sudden spike in inflation. Now, this is definitely starting to reverse. We see now that the saving rates of consumers are starting to decline. The credit card maxing out rates are actually hitting all-time highs. Delinquencies across the credit cards and autos is increasing, and we see that reflecting in, as an example, the price of automotives, used car sales is actually dropping. So there is a weakening of demand, definitely. Prices of commodities have fallen even below their previous levels, even before the inflation spike. So I would say overall the trajectory for inflation is definitely, or at least for the medium term, is looking down. Definitely it's not a straight path. There could be certain spikes and volatility in that. Now, how does the central banks react to that? I think one of the most difficult jobs in the world is try to be a macro forecaster. But the thing about macro forecasting is you don't have to always be right. You can always make forecasts and then adjust. The challenge that the Fed is facing right now is, I think it's trying to play, spinning the plates game. It's trying to control inflation, keep interest rates at a level where they're not too high to break the economy, but not too low that it spurs inflation again, all while, maintaining the narrative. One thing that the Fed always try to do is try to maintain the narrative that the sentiment around the globe is that we are tightening. Don't go out and start borrowing and buying and think that monetary policy will suddenly become loose. So they're trying to manage all of these things together, which I have to say is quite a difficult job. How does this translate to us as asset allocators? I think this is the time for active investment management. This is the time where you have to be very sector specific, asset class specific, and even manager specific. This is the time where out of each sector, you have to identify the best opportunities. Sectors are different. Even within the US, you'd see that some sectors right now are doing really well. As an example, the Magnificent Seven have been capturing all of the economic value and the economic profit, all while the rest of the S&P is relatively not doing as well. Even looking in real estate in the US, you see that commercial real estate is performing differently and is at a different stage than residential real estate. So this is the time where you allocate to active fund managers that will be able to identify which investments, which sectors are doing well given the current financial conditions, and allocate to that. Thank you.
Thanks a lot, Haitham. I think it's an important takeaway here on the reason of the inflation and what is happening now to get it declined. So any question from anyone? I just want to ensure that it's more interactive. Okay. Fine, good, yeah, okay. So moving to Hazem. Hazem, so it is a good news that the inflation is declining now, probably because the central bank in USA has been doing a lot of things over the past 2 years to fight the stubborn and escalating inflation rate through tightening the monetary policy or probably by hiking the interest rate. But it definitely comes with cost. What are the challenges or probably the risks associated with these actions, and what we need to do in order to ensure that our customers' investment portfolios are in a safe haven?
The risk, I think it's very obvious. I think Haytham...
After introducing yourself, please, Hazem.
Hazem Ayoub, I head the investment business for Mashreq Private Bank. The risk, I think it's very obvious, and I think Haytham touched upon it. While they're trying to fight...
Can you hear Hazem? Sorry. Can you hear him? Yes. Okay, okay, good, yeah, okay.
While they've been raising rates to tame inflation, basically they've been raising the borrowing costs, and tightening the financial conditions. And they're doing it on consumers and businesses. So consumer spending typically goes down, business investment goes down, and economic activity as a whole goes down. And if they were to do it so much, or to overdo it, frankly, they'll put in the economy into a recession. And majority of asset classes or certain asset classes will tend not to do well during a recession, but also there'll be some asset classes, typically the safe havens, will do relatively well in such an environment. So in terms of the risk, as I said, the risk that we probably will be facing a recession, but also if in the eventuality that this becomes a normal, let's say, slowdown, and it wouldn't go into a recession, there'll be some opportunities that probably rise from all this. We see typically, because of the higher interest rates that have been there, we see an opportunity in the fixed income space, which we haven't seen over the past couple of years. When they raised rates, we've seen a yield curve that was inverted, and we've seen a lot of interest from clients into the short end of the fixed income space. We've seen interest in treasuries, we've seen interest in investment grade fixed income. And the positioning has been towards a slowdown, and it's quality, basically quality, whether it's in the fixed income space or quality within the equity space. But having said this, diversification is the key. Regardless, the clients need to be diversified across equity, fixed income, private markets, and alternatives, and some of the stuff which was actually highlighted in the earlier session.
Thanks a lot, Hazem. Thanks a lot. Thanks a lot. Okay, in today's situation, Faisal, and while the interest rate has reached a record as well, so can we consider that the fixed income bonds is a must-have in our investment portfolios?
Hi, this is Faisal Hassan. I'm Chief Investment Officer and Head of Asset Management at MEA Capital, which is an onshore investment firm. So if you look at it from that way, yes, in terms of asset allocation, fixed income always has a major allocation. And I think all the panelists have alluded to the effects of inflation and higher interest rates. I might move it to a certain different path, that the portfolio managers will have a hard time adjusting and working into the environment where the real interest rates are not negative. So now they have to work on the environment where the real rates are between 2 to 3%. They were always working at negative 1%. So somebody who joined the industry in 2008 with a 15 years of work experience, that person is working with the real negative interest rates. And also on the central bank side, there was a huge sort of synchronization in terms of the yield curve, in terms of the interest rate structures. I think the only time I saw such high synchronization between the countries was in the movie Independence Day. So now the things have changed. Emerging economies are cutting rates, developed markets not so much, so that synchronization is not there anymore. So when you are looking at emerging market local currencies, the currency effect looks much more benign because we see the dollar probably weakening. Emerging market local bonds look attractive. On the other hand, I think that portfolio where we used to have the US treasuries because the US economy looks strong, I don't think so. It's a pure matter of demand and supply. US is printing a lot of paper which is not finding the buyers. The Fed is not there, international participants are not there, banks are not there. And they have to print those paper in order to take care of their fiscal deficit. So what we are seeing is, yes, within the fixed income environment, there will be a lot of churn in the portfolios. We'll be more going to the emerging markets, maybe on the local currencies. And one thing that we have to look at it, which probably my participant did not allude to, was on the currency side. And that adds to the GCC as a safe haven and on the fixed income. What we guys do not pay much attention or appreciation to is the stability in the GCC currencies and when we are doing our fixed income portfolio. So as a global asset allocator, ask anybody who has invested in Argentina, Venezuela, Pakistan, Egypt, Turkey, the currency killed the investment. Whereas we are pegged to the dollar, so there is no currency risk, which is one of the major risks when a global asset allocator goes to the emerging markets. So yes, the fixed income portfolio will have its effect, but I see a lot of churn in the portfolio. It will continue to have a major allocations, yes, but with the rising interest rate, there's a lot of transformation happening in all the asset classes. Some of it is visible, some of it is not visible, and I'm sure there'll be many shoes that will fall.
Thanks a lot, Faisal. What's your view here, Ali?
Look, I agree with the panelists in terms of tackling the issues with inflation, how we have to adjust the target allocation. What I would say, our sort of house view at DHF Capital is more so along the side of, we understand that rates are higher. We understand that rates are likely going to be higher. We are seeing some signs of diminishing inflation. We are starting to see the policies put into place by the Federal Reserve be effective. There's clearly a lagged effect from what we've seen from the time that rates are hiked to the time you actually see the impact of that in your residual portfolio, right? Part of what we need to do and think about is when we talk through target allocation, when we look at fixed income specifically as an asset class, is this an environment where investors should be locking in? And I think partly the answer is yes, but I also like the point that one of the panelists mentioned regarding active management when it comes to asset allocation, right? There's no longer an approach here where you can sort of sit on a base allocation and say, okay, we're going to sit here and we're going to look at this for the long term. Sure, you may have a diversified enough portfolio where there may be counteracting effects within different asset classes, but it's important to actively manage that portfolio and understand the volatility and do a risk assessment to see how it's changing throughout these volatile economic times, right? My view on fixed income is very much tied to the rate cycle. If you look at a 5-year or a 10-year treasury right now where it's yielding north of 4.5%, it's important to also understand the real interest rate environment associated with that. Adjusting for inflation, that figure is obviously a lot lower. Now, you may be holding these yields to maturity depending on the type of investor you are, whether it's institutional, whether it's sovereign, pension, individual, et cetera. So it's important to know what your target goal is and how it fits within the current context of the economic environment, right? I'd say on the corporate side, if you look at a lot of corporate issuances and bonds that tend to add a favorable spread on top of what you see to U.S. Treasuries, you get into the range of 8 to 10%. And what we've been focused on is listening to our investors and helping them structure portfolios and products which give them an element of safety in return during this volatile time, right? So it's important to be considerate of the ongoing volatility. It's important to readjust and retweak your asset allocation on an ongoing basis. And yes, fixed income is going to be a part of that, but how much of it is going to be fixed income, that needs to be constantly reassessed.
Thanks, Ali. Thanks, Ali. This is really pushing us to ask a question which is related to that. And traditional investment options we have today, like the gold, the silver, the fixed income bonds, probably the normal bank saving accounts, the US treasuries, the CFDs, and many other options, probably even saving money under the bed mattress. Are these still available and dependable options despite all these challenges? Would like to hear from you, Aisha, on that.
Thank you very much for that question. Yes, so the traditional investment instruments are obviously still available. If you look out today, even in a normal fixed deposit or a normal savings account, there are rates as high as 6% that are being offered in AED. At the same time, you have US Treasuries. I think there was a reference to US Treasuries as well. You know, you can get as high as 4.5%, and if you lever it, a lot of banks do offer margin finance and leverage facilities, and if you take a 70% LTV on that, and then when you take that leverage and you use a loan swap, your yields can go all the way up to what, 9-10% in a year. It all depends upon the level of risk a client is willing to take and the time horizons that the client has in mind, as well as the enthusiasm of getting a faster return in a more safer environment, because that's what everyone wants, right? I want quick return, I want it safe, and I want to do it all over again. So having said that, yes, the traditional investment products in terms of deposits, in terms of vanilla mutual funds, in terms of single security bonds, or bond funds for that matter, are obviously available. And do they have a place in a client portfolio? Absolutely yes. So I think when you sit with any financial advisor, whether it's a robo-advisor, it is do-it-yourself advice after reading some analysis, or really sitting with a person and a proper certified investment advisor, they will all, by and large, tell you the same thing, which is build your core portfolio and then build satellites around it. But be very careful in terms of managing your time horizons. There's a lot of people who do what we call systematic savings plans or regular investment plans, which is basically dollar cost average over a long period of time. Even those are getting a beating today. So those who took those options at the time, did they make a wrong choice? Absolutely not. But is it going to pay off over the long term? Yes, because whilst past performance is not a guide to what happens in future, we have seen and we repeatedly see that equities over long term tend to outperform any other type of investment. So absolutely they have a place in your portfolio, and let us not forget that traditional wealth management products, traditional investment products must form part of your core portfolio, and then you can do some sexier products as satellites around that to the extent of risk that you as a consumer or investor are willing to take. Thank you.
Wonderful, Aisha. Thanks a lot. Your view as coming from a local bank, Haitham.
I think regarding what you just asked, yes, definitely the traditional asset classes will always be a staple in I would say, most investors' portfolios. Of course, it would differ from one investor to another in terms of how you set up your strategic asset allocation. However, I think one very important tip for people that are building out their portfolios is to first and foremost start with their long-term objectives, with their risk constraints, and any other like liquidity requirement, and then build the portfolio and not try to be reactive to current market conditions. The last thing you want to do is just simply because, you know, the narrative right now is rates are higher for longer, or inflation, or an expected recession, that you build your whole portfolio around that. So it's very important to start first with your own goals first, and then you can tactically shift the asset allocation, but try not to overdo it. Do not time the market. Timing the market has been one of the most difficult things to do. When it comes to asset class views, I would say I am selectively bullish on equities. The reason for that, and as Aisha said, equities have proven time and time again that they are one of the best options to generate long-term returns. I also believe there's a fundamental reason for that, is because when you invest in equity, you actually participate in the full upside, the full economic upside of a business. While in fixed income, touching on what Mr. Ali has said, is that you barely, on a real return basis, you barely beat inflation and be compensated for the risk. So I think, yeah, definitely you want to have equity in your portfolio, and then balance it out, balance that allocation with what is your risk profile. There is always a place for alternatives and private assets in your portfolio, but it's very, very important to allocate it also correctly. I would say a general rule of thumb for a private investor would be between, I would say, if it's a high net worth that can actually afford to invest in private assets, between 5 to 15%. What I've seen is that family offices would go above that, and that is for the fact that most of the family offices invest like in a more of a generational wealth management kind of investment, where they can afford to invest in something that can only pay off after 10 years or 15 years. So always, manage your asset allocation based on what's your objectives, not based on what you think the narrative is, or reacting, to short-term market movements.
Wonderful, Haitham. Faisal, do you have a different view coming from a local asset management and investment firm?
No, if we look at it, yes, the markets have performed, and there is the bad part is when the markets go down, the correlation increases with the regional markets and the international markets. When the market goes up, the correlation decreases. So we are again of the view that yes, the public markets have adjusted. The only area of concern in my view, and I have been talking to investors, is on the private side actually. The private markets and the secondaries that we are seeing has not still adjusted. So maybe some of my investors are carrying those private investments at book because there has not been a round of funding or a down round. And on the secondaries also, things are not looking that rosy. And also, especially in the region, we like real estate. We did a lot of local and international real estate, and those were giving the yields of around 8.5%. Now that has gone, because if national bonds or banks are giving you a rate of return of 5-6%, then 7.5-8% on that risk curve of the international or the regional real estate does not make sense. And the kind of deals that we saw on the international income generating deals around 5-6 years ago, they were done at a 0% interest rates. Now the problem is these things have come for refinancing. So either you have to sell, which you are not being able to sell because of the situation in the international real estate market on the cap rates. And if you go for refinancing, now you are refinancing at a 5% plus. So all the yield is gone. So that is affecting the investor's portfolio. And definitely on the private side, we have to look at it. On the fixed income equities, still people are looking at solid companies, the dividend paying, the dividend yielding stocks. So there the strength of the balance sheet matters when we look at the regional or even on the international companies, because what looks like you have to filter through it. So if you look at S&P 500, the biggest index, it's the 7 companies that are taking the index up. 93 companies are taking the index down. So things are not looking as rosy for the international markets as well. So yes, diversification helps, but then I think the money markets is going to outperform the normal. They are going to be in the top quartile this year if you're not in the magnificent 7, what did they say?
Wonderful. Thanks a lot. Thanks a lot, Faisal. It's a very important takeaway here. Thanks a lot, Faisal. So we have seen over the past number of years that some of the global central banks have been working very, very hard to legalize and regulate the investment in what is called the cryptos or the digital currencies. Do we foresee a future promising opportunities investing on these assets, given that some of the giant asset management firms have already started talking to SEC in USA in order to get licenses in investing in the Bitcoin and other digital currencies? An example of them is the BlackRock. A question is to you, Hazem.
That's a very debatable, controversial topic. Yeah. But when it comes into the crypto, there's no doubt that the underlying technology, the innovation in the blockchain, which is on the underlying technology, will eventually or potentially revolutionize a lot of industries, and mainly probably the financial industry. But the crypto space is highly correlated to risky assets. It's highly volatile. And some of these projects, the long-term viability of these projects is uncertain. And mainly it's driven by speculators. While regulation is evolving, it's still uncertain. And because of this lack of regulation in the space, or clear regulation, we've seen a lot of bad actors in the space. And we've seen over the past year or so a number of large bankruptcies that you probably have seen in the media, your FTX, Celsius, and some hedge fund, 3 Arrow Capital, which shook the confidence within the space and probably have reduced the appeal of the investing in crypto for the main investor. However, and as we speak, there's about 10 applications for a Bitcoin ETF, and I'll touch upon this because there's a lot of interest in Bitcoin in particular, and especially when we speak about crypto, vis-a-vis the alternative or what's known as the altcoins. So there's 10 applications for a Bitcoin spot ETF, and these applications are coming from BlackRock, as you alluded to, but they're also coming from Fidelity, from WisdomTree, from ARK Invest, and a number of others. And the interest in Bitcoin stems from some of the characteristics which it probably has similar to gold. It's a scarce asset. Yeah, there's a finite supply. So it has this hard money property. It's divisible and transferable. While it might not have the same utility as a gold, but it's a relatively young asset. It's about 15 years old. And it has performed over the past, whether we take a look at it over 5 years, 10 years since inception, it's one of the best performing assets. And I would expect if a Bitcoin ETF gets approved, that will increase the accessibility for private clients, liquidity, transparency, and we'll tend to see more institutional clients, private clients coming to the space to do allocations. And no wonder actually, just prior to the session, before we stepped in, I was happy to see that there was some allocation they're advocating, and this is what eventually would expect. And I would assume or expect, yes, it can become a safe haven asset, yeah, in majority of client portfolios.
Thanks a lot, Hazem, an important takeaway, so crypto can become a safe haven for investors. Thanks a lot. So probably we need to close today by getting something from Saqib.
Okay. I just want to draw your attention towards a slightly different segment of customers. We've been talking about some, some instruments here, how to invest and all. At National Bonds also, we saw that, there is after coming out of COVID, every segment of the society wanted to save something. So we went to the blue collars, we went to, the white collars, and even to the ultra high net worth customers. So a lot of these guys, they stay out of this arena and, go towards the real estate and all side, and keep the money in the banks, place something on a little bit, very simple instruments. So to bring them into this, where they can start investing, saving with us, we saw that, very simple products, which has, no frills attached to it. You remove all the fees around that, and build it into the price though. But, these are still profitable for the financial institutions. But you go to these segments, go with the simpler products, and you start, getting these customers into the fold. So we have done that very successfully over the years. And I would strongly urge, all institutions to go towards this segment as well. Now they have understood the value of saving and investing, and we need to provide them the equal opportunity to do that. Thank you.
Thanks a lot, Saqib. Thanks a lot, everyone. Very informative panel, and the most important takeaway for me myself is probably I will jump from the technology area and join the investment area. Thanks a lot, everyone. It was really interesting having you in the panel, and thanks a lot, everyone. Thanks.
Thank you, panel. Very good.